Capitalism is the system of freedom. That's the slogan. But from the very beginning, freedom inside capitalism depended on one thing: ownership. Welcome to the Financial Historian Files, where money, power, and history collide, and nothing is ever as simple as it looks. We are taught that capitalism liberated humanity from feudal hierarchy, that it replaced inherited privilege with merit, that it gave individuals the freedom to trade, to innovate, to rise. And compared to medieval systems of fixed status, that narrative contains truth. Markets did expand opportunity. Trade did loosen rigid social structures. Wealth became more fluid. But here's the uncomfortable question. When capitalism was born, who was actually free? To answer that, we have to rewind to the 16th and 17th centuries, to the period historians often call the dawn of modern capitalism. This wasn't a world of scrappy entrepreneurs coding in garages. It was a world of empires, charters, monopolies, and gunpowder. In 1600, the British East India Company was granted a royal charter by Queen Elizabeth I. 2 years later, in 1602, the Dutch East India Company, the VOC, was formed. These were not ordinary businesses. They were joint stock corporations with state backing, monopoly privileges, and, in the Dutch case, the power to wage war, negotiate treaties, and establish colonies. This is important. When the first major capitalist enterprises were not operating in a free market of open competition, they were granted exclusive rights by governments. They were protected by naval power. They were allowed to suppress rivals. Shareholders enjoyed something remarkable: limited liability and access to global trade profits. Risk was distributed. Capital was pooled. Ownership could be bought and sold. These were revolutionary innovations in financial history. But let's be precise about what kind of freedom existed here. It was the freedom to own shares in a monopoly backed by military force. If you were an investor in Amsterdam, you could purchase a piece of a company that controlled trade routes, spices, textiles, and colonial ports. You could accumulate wealth without ever setting foot on a ship. Ownership became abstract. Returns became scalable. If you were a local competitor in Asia facing a company backed by cannons and exclusive contracts, your freedom looked very different. Capitalism did not emerge in a vacuum of liberty. It emerged intertwined with state power. The early corporate form was a legal creation. Contracts were enforced by courts. Monopolies were protected by navies. Property claims were backed by armies. Markets require rules, and rules require force. So from the beginning, capitalism was not freedom from the state. It was freedom structured by the state. Now let's move from the seas to the soil. In England, between the 16th and 18th centuries, a transformation was underway that would reshape the economic lives of millions: the enclosure movement. For centuries, many rural communities had access to common lands, shared fields and pastures used for grazing, farming, and subsistence. These commons provided a measure of autonomy. Families could survive without selling their labor full-time. Enclosure changed that. Through a series of parliamentary acts and private agreements, common lands were fenced, privatized, and consolidated into larger estates. Land that had supported communal survival became the property of individuals. Smallholders were displaced. Traditional access rights evaporated. This was not a side note in economic history, it was foundational. Before enclosure, a peasant with access to common land could sustain a modest existence independently. After enclosure, many had no choice but to enter the labor market. They became wage earners. Capitalism did not simply free labor, it created labor markets by removing alternatives. Freedom of contracts sounds different when your previous source of subsistence has been legally enclosed. This is where the romantic version of capitalism begins to crack. The system expanded the freedom to buy and sell. It expanded the freedom to invest, but it also increased dependence on wages for survival. If you owned land, you benefited from rising agricultural productivity and market integration. If you lost access to land, your freedom became the freedom to sell your labor. Ownership mattered. Now fast forward to the Industrial Revolution in 18th and 19th century Britain. Factories multiplied, textile mills expanded. Steam power transformed production. Capital accumulation accelerated. Industrialists were free to invest, expand, and innovate. And they did. Productivity soared, output exploded. Britain became the workshop of the world. But walk into a factory in Manchester in 1830 and ask a different question. Who inside that building was free? Workers often labored 12 to 14 hours a day. Child labor was common. Safety standards were minimal. Labor protections were weak or non-existent. Wages fluctuated with market cycles. This is not an emotional argument. It is documented economic history. Capitalism unleashed enormous productive power. It generated growth on a scale feudal economies never achieved. But the distribution of freedom within that system was uneven. Factory owners were free to allocate capital. Workers were free to accept employment or face unemployment and poverty. The distinction matters. Capitalism consistently rewards ownership of productive assets more than labor contribution alone. This is not a moral accusation. It is embedded in how returns are structured. Owners receive profits and capital gains. Laborers receive wages. Profits can be reinvested. Wages are typically consumed. Over time, that difference compounds. If you own a factory, you benefit from rising demand and productivity. If you work in the factory, your income is tied to hours and negotiated wages. If the factory becomes more efficient, returns to capital often outpace returns to labor. This is why industrial wealth concentrated so dramatically during the 19th century. Figures like Andrew Carnegie and John D. Rockefeller did not merely work harder than everyone else. They owned the means of production at scale. Railroads, oil refineries, steel mills, these were capital-intensive systems. Ownership amplified freedom. Labor remained constrained by bargaining power. To be clear, capitalism did open doors that feudalism kept shut. Individuals could, in theory, accumulate wealth beyond hereditary status. Markets allowed mobility. Urbanization created new pathways. But those pathways were navigable primarily through access to capital, credit, and property rights. Freedom existed, but it was structured. By the late 19th century, industrial capitalism had produced unprecedented fortunes alongside stark inequality. The Gilded Age in the United States saw massive consolidation of corporate power. Trusts dominated industries. Railroads shaped national markets. Financial capital grew increasingly influential. Again, ownership defined leverage. When crisis hit, such as the Panic of 1873 or the Panic of 1893, it was financial actors and industrial magnates whose decisions rippled across the economy. Workers bore unemployment. Farmers faced foreclosure. The freedom to speculate and consolidate carried consequences for those without buffers. And yet, the narrative of capitalism as freedom gained strength. Why? Because compared to rigid aristocratic systems, markets felt dynamic. Because compared to state-controlled economies, private enterprise felt voluntary. Because innovation was visible. Because fortunes were made. But visibility can obscure structure. A system that allows movement is not the same as a system that equalizes leverage. Capitalism reorganized power around property rights. Those who held enforceable claims over land, factories, ships, and eventually financial instruments possessed amplified agency. Those without such claims navigated within narrower margins. This is not a condemnation. It is an observation. Capitalism expanded certain freedoms dramatically. Freedom to trade across borders, to invest in enterprises, to accumulate beyond lineage. It also expanded financial complexity. Joint stock companies, stock exchanges, insurance markets, these were engines of growth. But growth does not eliminate hierarchy. It transforms it. Feudal systems tied power to bloodlines and land tenure under monarchs. Capitalist systems tied power to capital ownership under legal frameworks. The players changed. The structure of leverage remained. So when we say capitalism is about freedom, we need to ask a sharper question. Freedom to do what? Freedom to work? Yes. Freedom to trade? Yes. Freedom to accumulate? Only if you have access to ownership. From its earliest corporations to its industrial magnates, capitalism has consistently privileged those who control productive assets. It has rewarded risk-taking, innovation, and investment, but within a legal architecture that protects property above all. Without enforceable property rights, capitalism collapses. Without courts, contracts fail. Without states, capital is insecure. This is why the idea of capitalism as pure freedom detached from power is historically inaccurate. The system requires structured authority to function. It requires law. It requires enforcement. It requires political alignment. The real shift was not from power to freedom. It was from hereditary power to capital-based power. And that shift changed everything, including who could rise, who remained dependent, and how wealth concentrated across generations. By the end of the 19th century, the pattern was visible. Capital ownership generated compounding returns. Labor generated income. Both were necessary, but they were not equal in leverage. The promise of capitalism was opportunity. The mechanism of capitalism was ownership, and as we move into the 20th century, something even more powerful happens. The language of freedom becomes inseparable from the system itself. But before we get there, sit with this tension. Capitalism did expand liberty compared to feudal constraint. It also embedded that liberty inside structures of property and capital. The question is not whether capitalism created freedom. The question is whose freedom it prioritized. And that distinction will matter even more in the modern era. By the mid-20th century, capitalism was no longer just an economic system. It had become a political identity. After World War II, the world split into rival ideologies. On one side stood centrally planned economies under communist regimes. On the other stood market economies led by the United States and Western Europe. In that geopolitical battle, capitalism wasn't described as a structure of ownership or a framework of property rights. It was framed as freedom itself, freedom to choose, freedom to speak, freedom to trade. The Cold War hardened that narrative. Markets became synonymous with liberty. State planning became synonymous with oppression. Economists like Milton Friedman argued that economic freedom was a prerequisite for political freedom, and in many ways, that argument resonated. Private enterprise did allow decentralization. It limited the state's direct control over production. It fostered innovation and competition. But something subtle happened in that shift. Capitalism stopped being described as a system of incentives and began being described as a moral good. And when a system becomes a moral identity, critique feels like heresy. Yet, even during the height of free market rhetoric, the reality was more complicated. The post-war decades were not a laissez-faire paradise. They were heavily managed economies. Central banks steered monetary policy. Governments funded infrastructure, education, and defense. Labor unions negotiated wages. Regulation shaped industries. This period, roughly 1945 to the early 1970s, produced broad middle-class expansion in the United States, Western Europe, and parts of Asia. Wages rose alongside productivity. Home ownership expanded. Social safety nets strengthened. Capitalism looked like shared prosperity. But here's the detail that matters. Asset ownership was still the core driver of compounding wealth. Wages provided stability. Ownership created leverage. Then came the 1970s. Inflation surged. Oil shocks disrupted supply chains. Stagflation rattled confidence in Keynesian management. The pendulum swung toward deregulation and financial liberalization. The late 20th century ushered in what many call financial capitalism, a system increasingly centered on capital markets, equity ownership, and global investment flows. Again, the rhetoric was freedom. Deregulation meant freeing markets from constraints. Capital mobility meant freeing money from borders. Privatization meant freeing industries from government control. But the mechanics tell a more complex story. When financial markets expand, asset prices matter more. Stocks, bonds, real estate, these become central to wealth creation. Those who own assets benefit from appreciation. Those who rely solely on wages remain tied to labor markets. Consider the decades since the 1980s. Equity markets have delivered substantial returns over the long term. Real estate values have risen dramatically in major cities. Financial instruments have multiplied. Meanwhile, wage growth in many advanced economies has lagged productivity gains. Income from labor has not compounded at the same pace as returns to capital. This isn't a conspiracy, it's structural arithmetic. If you own appreciating assets, your balance sheet expands. If you depend on wages, your income grows incrementally. If inflation rises, wages adjust slowly. Asset prices often adjust quickly. And here's where the freedom narrative meets friction. In theory, anyone can participate in markets. Anyone can buy stocks. Anyone can invest. But participation requires surplus income, financial literacy, and risk tolerance. It requires buffers. The freedom to own exists. Access to ownership is uneven. Take the 2008 financial crisis. Leading up to the collapse, financial institutions leveraged complex instruments tied to housing markets. When the system cracked, governments intervened on an extraordinary scale. The U.S. Federal Reserve expanded its balance sheet. The Treasury injected capital into banks. Central banks worldwide coordinated liquidity support. The stated goal was stability, and arguably, those interventions prevented deeper collapse. But look closely at what happened. Institutions deemed systemically important were rescued. Shareholders and executives in many cases retained substantial wealth. Asset prices eventually recovered, then surged. Homeowners facing foreclosure experienced a different version of market discipline. Nothing says pure free market like trillion-dollar backstops, funded by public guarantees. This is not an indictment of intervention. It is an illustration of structure. Capitalism in practice has always operated within a political framework. When risk threatens the system itself, states step in. Freedom exists within guardrails. Now bring this forward to the present. In the wake of the pandemic, governments and central banks unleashed unprecedented stimulus. Trillions of dollars flowed into economies. Interest rates were suppressed, liquidity flooded markets, asset prices soared, stock indices hit records, housing markets surged, technology valuations climbed. At the same time, inflation reemerged. The cost of housing, energy, and food increased. Wages adjusted, but unevenly. Those holding financial assets saw their net worth expand rapidly. Those relying on fixed incomes or limited savings faced rising living costs. The system did not collapse, it adjusted. But the distribution of freedom within it remained asymmetric. If you owned diversified assets, you could navigate volatility. If you were leveraged, the environment was riskier. If you lived paycheck to paycheck, inflation felt like erosion rather than opportunity. This is the modern expression of a centuries-old pattern. Capitalism prioritizes property rights. It protects ownership claims. It enforces contracts. It channels incentives toward accumulation. It also produces mobility. Entrepreneurs do rise. Immigrants build businesses. New industries create fortunes. That dynamism is real, but mobility exists within structural constraints. The system does not require universal poverty. It does not function only when everyone loses. Advanced capitalist societies have generated massive wealth and lifted millions out of absolute deprivation. That historical achievement cannot be dismissed. Yet inequality persists because ownership compounds faster than labor. And that is the sting. Capitalism was never simply about freeing individuals from coercion. It was about redefining the basis of power. Under feudalism, power flowed from lineage and land granted by monarchs. Under capitalism, power flows from enforceable claims on productive assets. Freedom expanded, but it attached itself to capital. The freedom to start a business depends on access to credit. The freedom to invest depends on surplus savings. The freedom to negotiate wages depends on bargaining power. The freedom to weather downturns depends on buffers. These are not moral failings. They are structural realities. So when we ask, was capitalism ever about freedom? The answer is layered. Yes, it dismantled rigid, hereditary hierarchies. Yes, it unleashed innovation and trade. Yes, it allowed individuals to accumulate wealth outside aristocratic privilege, but it also reorganized dependency. It shifted leverage toward those who own and manage capital. It embedded freedom inside property rights, enforced by the state. Capitalism did not abolish power. It redistributed it. Understanding that distinction is not about ideology, it is about financial education. If you want real wealth, you must understand how ownership operates. If you want financial freedom, you must understand where leverage sits. If you want to navigate the financial system intelligently, you must recognize that freedom in markets is conditioned by access to assets and institutional protection. History does not hand you moral simplicity, it hands you structure. Capitalism is neither pure liberation nor pure exploitation. It is a framework of incentives built around property, profit, and compounding. It expands opportunity. It also stratifies advantage. The mistake is to treat it as a mythic force of absolute freedom. The smarter move is to see it as a system, one that rewards ownership, protects capital, and requires political architecture to function. And once you see that, you stop arguing slogans. You start asking better questions. Who owns the assets? Who writes the rules? Who absorbs the risk? Who captures the upside? Those questions matter more than whether the system carries the label free. History doesn't repeat. Sorry, but if you don't understand how power reorganizes itself, you'll mistake structure for destiny. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.